So who can explain to me forward versus futures contracts? Forward versus futures contracts. Forward versus futures.
Forward is defining what they're selling at a certain price.
Okay.
The futures is
So what you said so far is fine, but it's also, I think, if I heard everything you just said about that, those properties are with the futures contract too. So far from what you said. And so what did you say again?
I said they have a defined contract
Yep.
of what they're selling at what price.
And at what price? That's right. So those two things they share. So what was unique about the difference between the futures and forward contract?
Futures are the marketable security.
Okay, so the futures were the marketable security. So we really had a forward contract dealing with two parties. So I had the apple pie maker and the apple farmer making a deal with each other for futures. Now, what was the problem with that contract? Why it might not be operating quite as efficiently or effectively as we'd like it to be. Okay, so Jesse, you look like you're about to talk. No? Oh, okay. Then I won't make you. I thought you were just chomping at the bit. So illiquid, what does that mean? Subject to default risk, right? So that was one of the things. So that, and those are kind of two separate things, right? So the illiquidity of it would be that the person on the other end can't sell it. You're kind of locked in. And then furthermore, we've got this counterparty risk of one party or the other going out of business, can't make their deal happen or whatever. So to fix that, we had this futures contract by the broker dealers who's like, hey, I got an idea. Let's break this into smaller chunks. And I didn't think of it. Oh, you want to open the book? Let me show you. Just to motivate this a little bit, let me show you the chunks and what they look like. The book has a graph that I have on a PowerPoint somewhere, but this seems a little quicker to view. So I mentioned last time that with financial instruments, we've got the interest rate playing into this price. So we had the price of apples, but now we got to remember that interest rate and price are intimately related with financial contracts. So we've lumped treasury bonds, treasury notes, 5 years, 2 years, 30 days. So we kind of pick off some of the common types of debt instruments that are floating out there. And the broker broke them up into these $100,000 chunks. And so we fixed the volume that we're going to deal with. Because there's so many floating variables, to make it a standardized security, we broke them into these $100,000 increments. So it's still kind of lumpy, if you will, right? So if you want to buy shares of Apple stock, you can buy 3 shares, 4 shares, you can spend $10,000, you can spend $20,000, you can spend, right? But here you're in these $100,000 increments to buy one contract. So it is still a little bit lumpy is the word economists use for that. Stock index contracts, so you can bet against or for the Standard & Poor's with a futures contract, S&P 500, the NASDAQ 100, the Nikkei 225, and then we'll get into currencies later too, same type of thing. So we're applying the same apple pie logic, apples and apple pie logic, to financial securities. All right, questions or comments there? So how does the broker minimize their risk? So let's backtrack a bit to what you guys should have on your notes from last time. So we've got the 1,000 pounds. Let's see if I got this on. Yeah, let me do it this way, I guess. Center this up a little bit more. All I'm doing is shifting this over a little bit to center. So we got 1,000 pounds of apples delivered at some point in the future for delivery on, let's say, November 15th. And the broker's sitting in the middle with a deal for these guys bringing it in at the 20 cents. This is kind of playing off of your picture from last time. So we had the 20 cents coming in on the farmer side. They're going to get 20, so he liked that deal. So this is the farmer over here, or farmers, as the case is, with the now being commoditized. And then we've got the Pi Inc., the other customers, I think is what we labeled it last time. They're willing to pay the 22 cents, having the features of being able to avoid the counterparty risk this way, not having to worry about the farmer, whether they're going to be in or out of business. And so they got the spread. So what sort of risk does the broker take on? What sort of risk does the broker take on? A little louder?
Default risk with the party.
Okay. Yeah, so that default risk is still there, right? But now it falls on each party individually, and it's spread out. So the broker is diversified in that there might be a whole bunch of customers that they're spreading a default. A couple of them might go by the wayside, potentially. And then same thing over here with the farmer. So there's still that element of risk. Now, how could the broker hedge that risk?
By selling contracts.
That's not how, I don't know if they could. They probably could do that, I guess, but there's another way that's more directly related. So that would be kind of indirectly approaching it. So the broker's going to take on a little bit of a more direct approach here with hedging the risk and kind of keeping these guys honest, so to speak. In fact, he's going to do it in a clever enough way that he really almost eliminates the risk. How does a banker hedge against risk if they're giving a bank loan to a consumer? What are some of the things that the banker does? Collateral, so they got the house down as that. Okay, good. What else do they do? Monitoring, scanning, getting an application, run their credit score, right? So they check all the credit worthiness ahead of time. So that's one of the other ways that they kind of hedge their risk on giving out a bank loan.
That's by sell the contract, sell the loan.
Sell the loan, yeah, get out from under it is what we've learned from Chapter 5 that they did, kind of just, whoops, this one's awfully risky, I'll just sell it to Fannie Mae and Freddie Mac. So yeah, that's another way. But if they keep it in-house, there's one key thing that banks do. When you go to get a loan for a house, or maybe it's a business loan for that matter, they might require something of you, in addition to the things we've talked about. Down deposit, down payment, some skin in the game, actually putting some money down on it. Okay, so that's what the broker's going to do in this situation, is have these guys put some money down, because it's all future funds is where the trade's going to happen, right? So the broker's allowing to take on this deal at 22 cents, but he hasn't even paid them yet. This guy's willing to provide apples, but he hasn't even given them to him yet, right? So we're going to create an account called the margin account, which you've maybe heard about, right? So the margin account is going to be the broker's safety net. So over here, for the seller of the apples, we're going to have a margin account. And the margin account is going to be a fraction of the total contract amount. And the broker's free to kind of set that margin amount, likely to be like 10% to 20% of the deal. So let's say that the initial margin is $20. So hey, I will be willing to take this on with this 1,000-pound deal at 20 cents, as long as you put in 20 into a margin account for each of those. And the maintenance margin is going to be 10. I'll explain that more in a second. The maintenance margin. So put 20 into the pot. I'll keep a track of you at my brokerage house. I'm going to have $20 on account, and that's your margin account. So on day one, the seller has $20 in the margin account. The future price, the futures contract price, futures contract delivery price is what we want to start to keep track of next, is at 200. So 1,000 pounds, 200, 10% of 200 is 20. So that's kind of the game we're playing here. You put down the 10% and we'll roll. Oh, sure. All right, so on the buyer side, we're going to do the same thing. The buyer's going to create a margin account, and they're going to put $20 in as a little buffer. That's their skin in the game. And then eventually we're going to get down to November 15th. Now this is the futures contract delivery price. On this date, this seller committed to X amount of contracts at 200. This customer committed to X amount of contracts at 200. Right? So if there was multiple in here, this number would get bigger depending on the number of contracts they bought. Now, what's going to happen as we move down to the futures price? So let me go back to Chelsea first. What's your question? Okay, so this is, let's say today is, day one is today, I guess. What is today? March 18th. So today's March 18th, and we just agreed to a $200 deal, right? This guy said, yep, 200 works for me, done deal. We lock arms, Yellowbrook Road, and away we travel down to November 15th. Now, what's going to happen to the price come November 15th? It's going to change. Yeah, it's either going to go up or down. That was part of the volatility of the market. We don't know what it's going to do. Both of these two were trying to just know for sure what their deal was on that date. So let's say that day two comes, and you pull up the Chicago Board of Trade, and the new price is 190. The new futures price for the 11/15 delivery date, sure enough, prices have gone down. All right, yes?
Why is the delivery price the same for both parties since the buyer is buying them at 22 cents? Like, why is it 220 for the contract
It is. I have. I'm kind of leaving out that margin just for simplicity. Good question. You're right. That doesn't quite jive, but that is how the broker makes their margin on it. So that's their fee. So with the price change, who likes this and who doesn't like it? Who's kicking themselves?
The buyer.
The buyer, right? Because it's like, oh crap, I could have got it for 190. I locked in 200, and so they might be thinking, screw it, I just won't pay the broker, right? Would be the kind of their thought, or there might be chance for default if they wanted. Of course, the contract would be written so that in theory the broker has recourse against that company. You know, there'd be a contract, but that involves lawyers and lawsuits and all the whole jazz that we want to avoid. And so what that agreement says is that this buyer has to make up the difference of the price change. And so he's going to zap their account $10. So we're going to take that $10 out of his margin account as the price starts to change. Now, does this go into the broker's pocket? Who liked that price change? The seller likes that. And so we're going to come over here and we're really just going to take that 10 and add it back to the sellers, giving them now a margin account of 30. On the delivery date, or very near to it, if we go all the way down to 11/14, if you will, what is that futures price going to be awfully close to, if not exact?
200.
It's going not the 200.
Oh, the 200.
It's going to be the 190 or whatever it turns out to be in the meantime, right? So all I'm trying to, the futures price changes as we move through time. And eventually, if it's just the day before, it's like, let's say it's fallen to, let's say it rebounded back up to 250, right? So maybe it went down, but then it went up a while. And so we kind of rode this wave. If it's at 250 on one day before, that 250 is going to be equal to what it's actually going to be the day of delivery. That day is the day this seller is obligated to provide those apples, right? That's, you have to pay on the contract or deliver on it. Okay, so we'll come back to that in a second. I just wanted to think about this future price. Now, this $10 is a little bit special. If it falls another 10, how much does he have in his margin account? Zero. We're not going to let it fall to zero because that makes us have a little anxious moment, a little pucker moment, if you will. And so we're going to trigger a margin call if the margin account balance falls below the maintenance margin. So right now they're at that trigger point. So let's take it down one more level. Let's say that the price falls to 185. Futures price, this is on day 3 now. So day 3 futures price, look up Chicago Board of Trade and it says 185. We have an adjustment to the margin accounts accordingly, giving $5 for the buyers, and we're going to throw that into the seller's account, so their margin account's looking fine. And now we've triggered a margin call. And the amount that they're going to call is to reset it back to 20. So this is going to trigger a margin call, and they're not going to mess around with bringing it up to the minimum, but they're going to go all the way back up to the original margin call amount. So this triggers a margin call. Now, if you pay attention on some of those Wall Street-ish type movies, you can go back into Trading Places with Eddie Murphy, and that's a good old one. How many people have actually seen that in your age group, Trading Places? Oh, you guys should. Actually, that'd almost be a good one for this. It's super funny, and yeah, I could, I'd be tempted.
I could bring popcorn.
So are we going to do Wall Street or
Trading Places. So the guys are commodity. Actually, it's very applicable to this because they are commodities brokers, and they are doing this type of stuff with oranges. And then there's a little bit of deceit and underhandedness, of course, that you see in all these Wall Street movies of them. The fix was in about the orange frost was supposedly in. There was going to be a restriction of supply. They played the futures game and ended up. Oh, okay, pot rust. All right, so I better shut up here. All right, so triggers a margin call of $15. So note that it's the 15 that'll bring you up to the initial margin again. Now, where does that $15 come from? The seller, yeah, they got a, oh, over here?
No, the buyer.
The buyer.
But they both have.
So where though? Where does it come from? What account here with the broker?
It comes from their cash.
It comes from their cash account. So it's another injection of cash. I just wanted to make sure that that's what we're doing is we're making up the difference on the margin of call that it's causing real cash to have to come into the account. So their bet has not paid off and they're having to kind of fund the difference as they go. All right, so finally, let's say on 11/15, you can if you want. I'm just going to kind of stop things there just to note that you need to bring it up to 20. Because now I'm not going to show you the rest of the 180 days in between. I'm going to go dot, dot, dot.
Call add the $15 on day 3, or will it just be after?
Yes. No, you're right. They would have to add basically add the 15 and they'll day 3. In fact, it's supposed to be, I think, at the end of the trading day, they'll get called that and they have to replenish the account. So yes. All right, so now let's say that apple prices have plummeted to 100 on delivery day. And notice that with our numbers we've been using, that reflects 10 cents a pound. These guys negotiated the 20 cents a pound, which, just for Chelsea's sake, it's a good thing just to clean up your notes. Let's just say it's 20, just to kind of leave. We did that in the other set of the notes for the spread. Good detail, good detail. It's that accounting training, I can tell. Always catches me. So my business partner always caught me on all that stuff too. All right, so what is the reflection now in the margin accounts? Let's talk about the seller's margin account. What does the seller's margin account look like if, kind of skipping in time all the way down to 100, what does the seller's margin account equal? One what? 120. Remember, the 20 was their initial money before, and now the whole difference in price has been funded over time through these margin calls. As the price continued to plummet, that money kept getting funneled over here, and so this ends up having 120.
Over there, it's just 20, right?
Over here, it's going to be, yeah, not more than 20, because if they made a margin call the day before, depending on how the timing of the account came up. So let's put approximately, it's probably less than, or maybe I should just put less than or equal to 20. How about that? Less than or equal to $20, depending on how things shook out. Okay, now this is the important part is, what does the seller, I'm just going to continue, you guys can keep going down your plate here. What is the seller obligated to do according to the futures contract? What are they obligated to do according to the contract, the seller?
So they have to.
They need to get 1,000 pounds of apples. They obligated to deliver 1,000 pounds of apples to the market on that future date. How much are they going to get for their 1,000 pounds of apples? How much? For the apples alone. $100, right? 10 cents a pound, the market price. So then it almost seems like they got screwed, didn't they? They got the 100 on the margin account. That's how we made up the difference on it. So on the delivery day, the market price still stands. So on 11/15, seller sells 1,000 pounds at the current market price of 10 cents a pound. Which implies they are up $100 from the sale of apples. But they had locked in 200 was the deal. So as we've learned, they're now sitting with an extra $100 in their margin account. So this is the increase in the margin account, which is now their money, giving them exactly what they intended in the first place, which was the original deal to get $200. And on the buyer side, just the opposite. They get $100 is what they paid for the apples. But then they also paid $100 in margin calls. So that at the end of the day, they effectively paid $200, which was the original deal. They paid $200, they got $200. That's our futures market. What's that?
So the brokers get what's left over in margin accounts because they already have it.
No, those margin accounts are there. That's like a trust account. So that they'll get paid through the spread. The numbers would be calculated a little bit differently. Like Chelsea said, this would have been based on the 22 cents all the way down. So, okay.
What was the maintenance margin?
The maintenance margin was an amount set by the broker that said, hey, if your balance falls below this amount, then you need to pony up. So if it fell down, so if their when it fell down to $5, yep, they were underneath the maintenance margin, which caused them to make up the difference between their account balance and the initial margin.
Why didn't they just break up their accounts to the maintenance margin?
Because that's not the deal. By contract. I mean, good question. I mean, they would like to because that's less money. But basically, the broker, that causes transaction costs for the broker, right? They have to collect a check. They make the entry. You accountants are nodding your head. That's another debit and credit entry into the... So let's just bring it back up to here. At the end of the day, it's still going to be your money. You're going to get it back. It's not money that you're paying the broker. It's your money. You can liquidate it at the end of the deal after the delivery date. You'll get it back. Okay, so yes.
So the broker, if we had traded up through at the 22 cents,
Yeah.
then the spread at the end, just the difference is what the broker
Yes,
gets money.
that's right. Yeah, this one would have been a little bit higher, and then at the end of the transaction, the broker would have collected their money. Yep. Okay, let's talk Allison here, chapter 5. So, fun chapter. I think he didn't hold back any punches again like he did before in a couple spots. Let's see. I'd like to hear from somebody we haven't heard from initially before. Whoever you are, go for it.
I feel like this chapter tied back to that video that we watched a lot because of like the craze for everybody to want to own houses and
Yeah.
like thinking of them as investments. So kind of like when that scout
A little bit, but he's been talking more about it in earlier chapters. What part of the book did you like especially? Like, what do you got a specific spot that you liked?
I was just kind of going off the page. How do you say that he understands how people want to own houses, and that just reminded me of like the video of how everybody was wanting to take out these huge loans and how unfortunately are just investments rather than as.
What else did he say about lifestyle of housing though later?
I thought it was interesting how he thought the government didn't have a choice in how we should live the lifestyle that consumers choose.
Yeah, so we were kind of, he said it later after saying he can understand why people don't want to own a house, blah, 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 but at the same time, it's kind of a lifestyle choice. Some people like to maybe live in apartments or have the flexibility of renting, and so.
It's not all lifestyles are conducive to having a house if you're wanting to move around a lot. You
Right.
can buy and sell, and that's a lot different time cost and
Right.
stuff.
Yeah. And so by driving down housing prices, I don't think this is mentioned in here, but I think we talked about it once before. What happens to rents? What would be the effect?
By driving it down, your rent.
The rents, would that drive it down? So if we're affecting housing prices to make housing cheaper, so more people are going into housing, like he explains in the chapter, the rent might go up, right? So because there's less, if we think about a supply and demand curve, there's less demand for housing, bringing rents, that would be bringing it down.
There's less demand for apartments.
Less.
You were talking about the price of housing.
Yeah, that means like rent.
Yes, right. Sorry, I misspoke. Yeah. So yeah, we're kind of targeting, I think his comment there was kind of interesting on, is it okay for government to say, yep, that's the good thing for everybody? To drive down interest rates and let everybody who wants a home get a home. You know, that's kind of the mentality that he's challenging us on here, which I think is interesting. Okay, what else?
Oh, it was interesting that you kind of went after the Clinton administration for going after the race and the Community Reinvestment Act.
Yeah.
And it was like really structured to loans more available to low-income borrowers, but especially minorities and African Americans.
Yeah, that was on the page 59. The Friends of Bill was one of it. I guess there he was talking about the head CEO guy of Fannie and Freddie. Yeah.
On that note, Fannie and Freddie, I thought it was interesting that he kind of brought up, and he actually agreed with our economics textbook. One of the things where he was like, hey, government-sponsored enterprises, well, you know, that they need to be completely privatized and they need to be completely public. But this hybrid is a mess. Messing up the system.
I like the
economics
detail.
said the same thing, but it's not.
I like the detail that he gave on the hybrid part. What did he say? He gave a little more teeth to it, too, that I thought was some good insight on why the government-sponsored enterprise, the GSE, is kind of doomed, or the incentive structure is kind of messed up.
They have 75 to 1 to 1,000 to 1 leverage ratio or something like that.
Yeah, it created that. Yeah, and so what drives that leverage ratio? You're right. So that was on page 61 that we had.
That if they lose everything, they get it all back.
Yeah. So that, and it was on.
Make money.
Right. So on the expense side of the equation, we've got one thing, and on the revenue side, so they're all incentives are to go, go, go. And then that led to this distorted leverage ratio that was pretty scary.
Along with that always being able to make money, but the accounting from
Yeah.
He kind of took like an Enron approach to it, where it was like it doesn't matter whether it was legal or not, what they were doing was unethical.
Yeah. Yeah, I thought the accounting insight was also interesting. I remember that scandal just briefly. I just remember being in the headlines that they were, because it was shortly after Enron, they're like, oh, Fannie and Freddie got some issues too on what their values are and how they're reported. Okay, what else?
Well, if bouncing off of just his ethical comment, it said on page 57 that the subprime mortgages were driven more by ethics than by economics.
Yeah.
And then the Fair Housing Act, the Equal Credit Opportunity, they were supposed to eliminate or decrease discrimination. It just didn't work out that way. So
Yeah.
having those ethical, it doesn't necessarily
until I read this book, until I read this book, I didn't think about how far back it goes. I mean, this is bipartisan. This goes across, he talked about the Clintons here, but he also mentioned Bush administration too. I mean, we're talking back to 1968, the early 70s as far as starting to fuel the everybody needs a home type of thought and affordable housing. And so I thought that was something I never really thought about until I read this book.
I always thought it was interesting how he talked about it becoming almost religious, the ethical view, how they were kind of, I don't know if it was on purpose or not, but just they became kind of blind to the actual effects of what was happening because they're just so insistent that no, this is the right thing to do, and we're not going to do anything that's going to prevent people from owning a house.
Yeah.
And calls out, like, I forget the exact name. What's his name? Frank.
Oh, Frank, yeah. Barney Frank and Chris
He
Dodd.
says, like,
he was
says
smart
the
enough.
other ones weren't smart enough to realize the real implications.
That was the direct slam that I thought was
But
interesting. The
Barney
other ones were
Frank
clearly
was,
fools.
and he didn't do anything anyway. Yeah, that. And so I thought that was interesting. I also really like the sentence at the top of 58 that says, politically correct do-gooders cannot wish away the laws of economics.
Yeah.
And I kind of had like a small, like tiny scale experience with that. But I told you my dogs went missing, and
Yeah.
They got turned into prairie paws, and the lady was like, who turned them in, told them like, yeah, we found them in a field at I-35 and couldn't let them get hit or something. But my property is like 25 acres that runs along I-35, so they're probably in our back field, and someone took our dogs. And it's like, yeah, they're being do-gooders. Like they think, oh, these dogs are going to get hit or something, and so they want to just pick them up and take them somewhere where they think they'll be safe. But really, they're on our property, and they probably would have stayed on our property.
Yeah, because they've been around for a while. Yeah.
So
Okay.
just a little side.
Other comments on this one?
Just one thing I didn't necessarily understand was the very last page, page 65. It refers to natural market rate of home ownership. I just don't know who is he to determine what a natural market rate of home ownership is.
Okay, good question. Anybody got comments on that sentence? So that's the second to last paragraph. Fannie and Freddie's affordable housing lending, which was driven by a political goal to raise home ownership above the natural market rate. What do you think about Adam's comment there on who is he to decide what the natural, is that what you said?
Yeah, I mean, for anybody. I mean, isn't home ownership a good thing? I mean, obviously in this case, isn't there?
Right.
They create a bubble.
I think he's just saying that, I mean, theoretically it was I mean, at the end of the day, it was subsidized and people were receiving incentives to own homes rather than just...
But who chooses this natural rate?
Yeah, even regardless of if it was a misinvestment anywhere, it's still that he's still saying that there's a natural market rate of home ownership. There's still so many houses that don't have people in them that are still trying to be sold. So if they're still empty houses, I mean, I don't understand how we're above the market rate.
Anybody want to tackle that one? Jesse?
Basically,
Let me go Jesse here.
Well, I was just gonna say, especially with the government involvement, like how can you, if they've been involved so long, how can you determine that there is a natural, especially if there's...
Kind of hard to determine at all what the natural, yes, I'd agree with that.
I don't think anybody's really determining it. I mean,
Then how can you say it's above it?
But I think Michael's saying the
yeah.
direction of the bias would be downward bias rather than upward bias, right? Is that kind of, I mean,
like if everybody's offered free rent, then you're definitely going, that's never going to happen. But if everybody had free rent as an opportunity, then you're definitely going to have more people taking rent-based housing, or like just free housing in a rent situation, even though that doesn't make sense.
so I do want to hear who determines the natural rate. I think Adam's comment, this is good for econ students to think about. The people, yeah.
everyone in the market.
Yeah, so they're not any single person. There might be debate on what kind of like the natural rate of unemployment, or like economists think that it's between the 5 and 6% range or whatever. But if we have no government intervention, and people are considering all the things we're talking about. Should I rent? Should I buy? How long's my commute? Might I be changing jobs in 2 years or 3 years? You know, all the things that are going on. At the end of the day, if nothing's distorted, which is a big if, right? But if the whole pricing system's not distorted, then that would be kind of the natural rate for there to be, whatever that number is. I don't know what it is, but I think the bias would be downward given the policies that were in place. How far down, who knows? Because we've got a kind of a moving target of what the natural rate is, and then we've got maybe a moving target of how much that lower bound is, but we're pretty sure it's not up here, so it's somewhere down below it. So good, good. All right, we better call it a day there. I got to get to my final macro adventure. So 6 and 7 for Friday. It sounds like 2 big chapters, but they're actually, it's just 13 pages. It's about the same amount of pages as we just did. So 6 and 7 for Friday.
While you're packing up,